When I came back from Vietnam, I wanted my rich dad to teach me. He says, that's not his job. He says, you got to go learn. So I took real estate classes. And my first class was on infinite returns. So my first property was in Maui, on the island of Maui. And it was a 1-bedroom, 1-bath condo, was $18,000 down. And my job was to buy it with no money. So I put it on my credit card. It was $18,000. I put 10% down, and I made $25 a month. But I understood infinite returns. So at the age of 25, I knew I never needed money again. Now that kind of messed me up, because once you get a taste of not needing money, it kind of goes to your head. So again, it was a 1-bedroom, 1-bath house, $18,000. I broke out my MasterCard to put $1,800 on it, and I was making $25 purely on debt. Because debt is government. Government wants you to borrow, because in 1971, the US dollar became debt. We're functionally business owners, we're entrepreneurs, big business. We have brands. Trump is a brand, Rich Dad's a brand. And we do most of our money in real estate. And then we save gold, silver, Bitcoin, and other commodities. One last thing I want to say this, because Jim Rickards brought it up the other day. He says the most misused word is diversify. You know, when a financial planner tells you diversify, they really are saying diversify. So you'll say, well, yeah, I'm diversified. I have oil, I have gold, I have real estate, but they're all in paper assets. And there's a difference between paper assets and real gold, real silver, real estate, and real businesses. So a stock is not a real business. It's a share of a business. It's a derivative of a business. So when these effing financial planners tell you you diversify, they're lying to you. Just because you have a paper asset in one of them doesn't mean you're diversified.
I use debt, as you know, Robert and Kim. I think why wouldn't you use other people's money? That's basically what it is. It's borrowing money from a bank. People put their deposits in the bank, and then they give them to me to invest in property. And so that's it's the greatest thing ever. And then we only have to come up with the down payments, so we use debt, and then Tom works his miracles on the depreciation side and the bonus depreciation and all the other advantages that we get on the tax side. So we make millions and millions of dollars every year, and we pay very little taxes, and sometimes none.
Yeah, and to your point, Robert, about you can't do this on your own. When we met Kenny, we were doing it on our own. And I was basically handling all the properties, and we didn't have a lot at that time. We had 3 apartment buildings and some single families, and I couldn't handle anymore because that took up all my time. And so when we met Kenny, I'm like, oh, yay, can you manage my properties? And he said, no. I said, I cannot. So we only work with like 120 units or more. And that's when the team came together, because as I was doing it on my own, I could only go this far. And I know a lot of people that are in real estate that can't go farther because their time is all they've got. So you've got to bring a team on. So we had Kenny, and then we brought on Tom, and it's the team that lets us grow.
Yeah, this is a very important point. Most real estate investors are here. You know, they have a duplex or a fourplex, and then property management gets them.
Yes.
And so what Kenny said to Kim nearly broke our heart. Kenny said, he said, Kim was so proud. I have a 30-unit apartment house. Kenny says, it's too small. So, not that you can't do the same tax laws, but Kenny can't manage it because in real estate, unlike stocks, see, the reason stocks are good or paper is good is there's no management. But real estate is management, and Kenny comes from the management style. So when Kim and I met him 20 years ago, he was like godsend to us. This guy can manage property. And unless you've been in real estate, you don't know. That is the Megillah. If you can manage real estate, you got it. Right, Kenny?
Yeah, in fact, even when somebody's giving you money, it doesn't matter who. That's the number one question they ask. Who's your team? How are you going to manage it? Who's going to manage it? Who are they? What's their experience? And so it's the most important thing, because handing somebody money is not that hard, but then having that money produce is hard.
Yes.
You have a book called ABCs of Managing Property?
Yep, ABCs of Property Management, we sure do.
That is the most important book if you plan on being in real estate. If you don't like managing property, people, and toilets, stay in the stock market. Right, Kenny?
Yeah, it's a day-to-day. I mean, right now we're dealing with hundreds of leaks, frozen pipes, and resident issues in Texas, as an example. We
Right.
sent 2 semi-loads of food and water out of Arizona this week, and so every week there's something. Trust me, we've had tornadoes, we've had hurricanes, we've had hailstorms, we've had fires, we've had all kinds of things. That's part of the business, but there is a lot more fun to it than that, actually. When you take somebody's money and you invest it, it's fun, I think, because now there's a way. Okay, how do we make this money, make more money, and how do we keep these places full, run them well? And there's a lot to management, and there's a lot of details. As you know, we have a company full of people we have a company full of people that are specialists in lots of areas.
So when guys like Dave Ramsey say live debt free, what goes through your head?
Well, I think that it's the dumbest advice ever, actually. I really do. It just makes no sense to me. I don't know. I mean, people are getting debt right now for 2.5%, 2.3, 2.4%. That's going to be less than inflation. So if you could lock that, if you could borrow at that rate, why wouldn't you? It's free money. It's literally free money.
Dave Ramsey is a friend. I've had dinner with him several times. I meet with him. His advice is good for stock people.
Yes, I would agree.
If you're going to go into real estate, debt is your best asset. And the reason that Ken and I always talk about this is a financial statement, okay? So you have income, expense, asset, liability. For the people on the B and the I side, the biggest liability is cash.
Yes.
Am I correct, Tom?
Absolutely.
And it
doesn't produce anything.
No, they're printing it.
Yep.
They're printing it since 1971. They've been printing it. So what happens is when Kim and I make money, income comes in here, and we have cash, we've got to move it into debt. We're converting cash into debt as fast as we can. But the key is property management, and then investor management and market management. So that's why anybody saving cash today and living debt free, it's good advice if you want to be poor.
Correct.
Now, but don't switch into real estate unless you're willing to understand what Kenny knows about real estate. So that's why his 3 books. Give us your 3 books again, Kenny.
The ABCs of real estate investing, the ABCs of property management, and then we have an advanced guide to real estate investing.
And that's what you need to understand, because when you say move your money into debt, if you don't know what you're doing and you're buying a property and you have no education, you have no experience, you don't know what you're doing, that debt's going to be bad debt.
And I remember you have a dad, Kim. Her dad was hardcore stock guy. He was hardcore buy, hold, and pray in the stock market, and that worked for him. But I told him we're buying real estate. He says, I refuse to fix toilets. Well, so
that was my plan. I was going to have Dad was going to be a business partner.
So just remember, paper assets are for some people, commodities, gold, silver, oil for some people, businesses are for some people, and real estate is the best. Because right now, the problem with Kim and I, our income is going up. And if Kenny doesn't find us a property pretty soon, we're going to pay taxes. So Tom, would you explain that psychology? Because this is on the B and the I side.
Right. So you have to start with the premise, of course, as we've said on the other episodes, that the tax law is a series of incentives to do what the government wants done. And one of the things the government wants done is they want housing built, okay? And they want commercial property built. So what they do is they say, well, we'll give you a tax benefit so that you're willing to go and risk your money, put in the effort and the time to go get, and to borrow money as well, because the government, of course, wants you to borrow money because that increases the amount of cash in the economy. And so it's all good for the economy. So what happens is the benefit that they give is what's called the primary benefits, what's called depreciation. And depreciation is magic, okay? Because while your property is going up in value, and you're increasing your rents, you're actually getting a deduction for more than what you paid, because you get a deduction not only for the amount of money you put in, but you get a deduction for the amount of money the bank put in. So the debt is important, from a return standpoint, but it's also important from a tax standpoint. So critical that you understand debt if you're going to get into real estate and get the tax savings that you guys talk about.
So let me show you a picture. Okay, so let's say Kim and I have $1 million coming in from our businesses. It's a liability to us because they're printing more money today. So I want to take this $1 million over here. I want to give it to Kenny. He's going to amp it up to 10 million. And exactly as you said, because the government wants you to borrow money because the dollar became debt in 1971 when Nixon took the dollar off the gold standard. They dropped the interest rates because they want you to borrow money. If they don't want you to borrow money, they'll raise interest rates. It's really that simple. So let's say it goes to 1 million here to 10 million here. What that does is reduce taxes here. Is that correct, Tom?
Right, because that $1 million is not just a liability because they're printing it, but it's a liability because there's $400,000 of taxes associated with that $1 million of income. And really, one of the best ways to get rid of that $400,000 tax liability is to take that money and convert it into real estate, because then the government gives you this big deduction for your money, for the bank's money, and it offsets that $1 million of taxable income. Your taxes go away.
So that's why, Kenny hears a panic in our voices all the time. Kenny, have you found another property yet? Because if he doesn't find any property, Tom is going to make me pay taxes. Is that correct, Tom?
The IRS is going to make you pay. I'm going to file the taxes.
And just to be clear,
really clear here.
And also to be clear, this formula is not just a U.S. formula. This formula is worldwide, correct?
It is. The U.S. right now has the best tax laws in the world when it comes to real estate. There's no question. But every country allows depreciation on investment real estate.
Final words, Ken. We have about 1 minute. So what do you have to say? Because this is why we're always calling you. We have too much cash. You've got to provide this for us so we can go into debt here and we can reduce taxes. Does that fit your psychology, your belief system?
Oh, yeah. I mean, Tom always says it perfectly, in my opinion. He says, if you want to see what the IRS wants, just look at their codes. And what the IRS wants us to do is invest in housing, period. And that's why we have... That's why we get the benefits from it. So we invest that money, we get the debt from the bank, and which is we're beating inflation, and then with depreciation and other things, we're actually able to take that money out tax free. So we're getting income. So we're investing our money. We're getting our income tax free. And if it's a value add deal, which you guys have been involved in a lot of with us, then you actually get your money back. And then we have, of course, what we call infinite return, which is you've now gotten your money back and you paid no tax, and that's a cash out refi. So you don't pay any tax on that, and you still get income. So you give me money, I give it back, and you pay tax legally, over that depreciation amount only.
So let me explain what I just said. So this $10 million property, it's throwing income here, cash flow. Let's say it goes up to 20 million. What Kenny's talking about is we borrow out the gain, and that comes to us tax-free, but that's now tax-free money. So we go from 10 million to 20 million due to inflation, or what you want to call it.
Well, I call that forced equity. So I buy a property at 10 million with the idea of bringing it to 20 before I buy it.
That's the value add, yes.
I already know how I'm going to do it. It's not just market driven. We're actually doing things to make it worth 20.
Yeah. So when Kenny pitches the deal to us, we already know we're going to put $1 million here. It's going to go to 10. It's going to go to 20. We're already getting income from the property. When the property goes to 20, we borrow out the 10 tax-free. Is that correct, Tom?
Well, that's right. And then you borrow out the 10, but then you reinvest that 10 into new property because you've got to constantly be investing in real estate. That's why I'm always after you guys. Look, you're making money. We need to constantly be reinvesting that money into real estate. And that's really how this system works. Now, real estate, let me say one last thing on the importance of real estate from a tax standpoint. It is one of the few places where you can actually reduce your taxes today and never pay taxes in the future. Now, you've got to have the right financial education, you've got to have the right tax advice, but you can literally eliminate your taxes from your business today and never pay tax on the income from the real estate in the future, even when you sell the real estate. I mean, it's unbelievable, the tax benefits in real estate.
Yeah, and that's why Hillary was going after Donald Trump. He said, well, you don't pay taxes. And he says, that means I'm smart. But they don't teach you this in school, but they'll tell you put your money in a 401k, which to me is a loser's game, but it's better than nothing. And don't do this at home if you don't know anything about real estate, because property management is the hardest part of this game. We'll be right back. Okay. Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about taxes and why the rich don't pay any taxes legally, and why the employee and the small business owner pays the most taxes. And as we know, President Biden is going to raise taxes. He says, we're going to tax the rich. Well, they don't tax the rich. They tax the poor and middle class. And that's the tragedy of this whole thing. Plus, they're going to print money, which causes inflation, which is a tax. And then they're going to raise the minimum wage to $15, which is another tax. And so that's why if you really don't want to pay taxes and make a lot of money, that's why this 4-part series at the Rich Dad radio program is about how the rich make more money and pay less taxes legally. It's the people who are on the E and the S side are the ones who cheat.
Taxes are so misunderstood, and everybody thinks taxes are evil. But as Ken and as Tom were saying, that taxes are an incentive for doing what the government doesn't want to do. So they're giving us tax breaks to do what the government doesn't want to do, create housing, create office buildings, things like that.
And borrow money.
So I think this series is very, very important, because the more you understand about taxes, the more sophisticated and better decisions you're going to make as you go into your world of investing.
And for those of you listening on the radio, you can't see this. That's why we have cash flow clubs of the cash flow game, because you can't learn this stuff by thinking about it anyway. The beauty of a cash flow game is you have to do it. And if you don't want to do it, then buy a 401k and pray. I mean, that's really where it's about. So our guests today are, again, our tax advisor, Tom Wheelright, and our real estate partner, Ken McElroy. Because Ken has made us wealthier over and over and over again. In 2008, when the market crashed, we all thought we would die and went to heaven because the real estate prices dropped, but so did interest rates. And so as soon as the market real estate dropped and interest rates dropped, Kenny says, I'm going to borrow $300 million. And when Kenny builds into his business plan that he's going to take that he's going to make the property more valuable, and we're going to borrow out the equity. We don't have to flip the property. So when we borrow out the equity, again, we don't pay any taxes.
The reason you don't pay tax when you borrow money is because that money is still owed to somebody. And so it's not income to you. You're going to have to pay it back. But the great thing about real estate, of course, is that your tenants are going to pay that back. All along the way, the government's going to give you this incentive called depreciation and allow you to use that depreciation to offset that income coming from the tenants that's paying down or amortizing your debt. So it's kind of the perfect storm in a good way. Let me add one more quick thing about what Biden wants to do, by the way. He wants to, when he says tax rich, he's talking about the high earning employees. That's who he's going after, is the high earning employees and small businesses. It's the E and the S. That's who he's going after. He is not going after the B and the I, and especially the I. The I is never going to change, because that's where the government gets most of its work done. And while it might shift from oil and gas to solar, it's still the same thing. It's an incentive to do what the government wants done. That's right. In the inside investor, that I quadrant, and that's where you get zero tax.
And it's all based on debt and taxes. So when somebody says live debt-free, I check out. Because,
well, you're going to pay a lot of taxes if you don't have any debt.
Yeah, and the reason is 1971 when Nixon took the dollar off the gold standard, the dollar became debt. And the only way money is created is when you borrow money. That's why they want you to have credit cards and all this, because if you stop borrowing, the whole economy seizes up.
And Robert, you said something earlier about when the market crashed. You know, in 2008, when the market crashed, we did very, very well. So one of the keys to financial education is we knew, and Kenny and Tom and Andy Tanner with paper assets, cash flowing paper assets, when the market goes down, we do really, really well. For the average guy out there, when the market crashes, they crash too. Their 401k crashes, their retirement plan crashes. They don't know how to make money when the markets crash. So that's really the key importance, I think, for financial education, because there is going to be a crash. And are you prepared, and can you take advantage of it?
And the tax law wants you to borrow money. And I think it's funny when somebody asked me the other day, Kenny says, what's your net worth? I said, about a negative billion.
Yeah.
They don't realize that debt is money.
Right.
It became money in 1971. And the more money I borrow, it's tax-free money. Is that correct, Tom?
That's exactly right. Tax-free.
The government wants you to borrow money because if we don't borrow money, the whole frickin' economy grinds to a halt.
It's just like you said, Kim, you know, the tax law is incentive to do what the government wants done. Well, one of the things the government wants done is they want that money borrowed from the banks to flow through the economy. And so not being taxed on debt is an incentive to borrow, and we can't ignore that that's what it is. It's an absolute tax incentive to go borrow money.
Because cash is a liability to us because they're printing it. So it goes in here, you put it into $20 million, you ramp it up to 40, and meanwhile we're getting cash flow. And Tom, why are we paying no taxes on all this?
Well, because first of all, you're paying no tax on the debt because you're going to pay that back. Second of all, you're not paying tax on the income from your business because the depreciation from the real estate is offsetting that income.
It's the income from rich dad.
Right.
Understand that the reason we're B's and I's is that by investing in real estate, in the B, we make the money in the B, and we invest with Kenny in the I, and that offsets our taxes in the B. Am I correct, Tom?
That's correct. Now, one thing that you mention all the time is in the I quadrant, that's not just any investor, that's the inside investor. And that's very important. In the US, especially, if you're a casual investor, you don't get the same benefits. You must be a professional investor and an inside investor. And then not only do you get, all the better interest rates, you get the better deals, you get things before they come on market, et cetera, but you also get better tax results because Kim is an inside investor. She's professional. She's a professional in real estate. She spends a lot of time at real estate, and that's what allows her to get these tax benefits that the average casual investor is never going to get because they don't understand how the law works.
So this is where Kenny kicks in. So we saw this piece of crap property. I was ready to run. When I saw that toilet in front of the fireplace is burned in my mind. And I realized the guy who owned it before we did, his business plan was to just strip it. That was his business plan. So Kenny goes in there with his team. And I didn't believe Kenny. I saw his team. I forget your guy. This guy, he looked at it. He was just as excited as Kenny because he knew he could fix it.
Again, Robert, once you start to do this, whether it's one unit, or in this particular case, it was 400 that we needed to fix. It was a 680 unit property. It's just math. Literally, some units are $1,000, some units are $10,000. You have to figure all that out before you buy it. That was a big number. That's why we raised all that extra money. And the bank wants that. The community wants that. Everybody wants that. Everybody wants somebody. It's no different than if it's a house in the exact same condition.
So keeping the math simple. So Kim and I have $1 million on, to us, the cash is a liability that coming from rich dad. We move it into the 20 million.
In the asset column.
In the asset column. We turn it into debt. We took cash, convert to debt. Kenny improves the property to 40 million. So meanwhile, we're making all this cash flow from the original $20 million debt. But let's say he raises it to 40. That 20 million comes out as debt Why is that tax-free, Tom?
Because you have to pay it back. So the government says it's not your money, it's the bank's money. You're using their money, but you have to pay it back. So you're not taxed on it. But here's what's even better. Not only are you not taxed on the debt, you get to deduct the interest. So if you put your own money in, you don't get to deduct the cost of putting your own money in. But if you borrow the bank's money, you get to deduct the cost of putting their money in. And by the way, that's something that's true all over the world. All over the world, you get to deduct interest expense, but you don't get to deduct the amount of money you put in as capital.
When I met Kenny for the first time, this is 20-something years ago, everybody was flipping property. Remember that?
Of course. Yeah. They're doing it again right now.
Tom, what happens when you flip?
You have the worst kind of income, what I call earned income, which is like ordinary income with the additional tax of Social Security on top of the ordinary income. So you're at the super highest rate. That 60% bracket that you talk about in the S quadrant, that's for flippers.
And let me ask you one more thing, Tom, because here's one other huge tax benefit that I like. Okay, let's say you have a property and you're going to put down 20% of the 100% cost. You put down the 20% in cash, but you still get 100% of the tax benefits, correct?
That is correct. So you leverage your tax benefits. In other words, you get 5 times the tax benefits than if you just put down than if you paid cash for it.
So in the tax law, which is Tom's book, Tax-Free Wealth, there's appreciation, depreciation, and amortization.
Right.
So by doing this formula, appreciation is tax-free.
Correct.
Depreciation is income.
It's the tax benefit.
Tax benefit. And amortization is the bank gets their money back. That's tax-free money too.
Well, that's tax-free because the depreciation covers that. It would be otherwise taxable, but because you've got depreciation, it offsets that amortization.
Don't do this on your own.
No.
I mean, Kenny definitely could not fix that toilet. I know that for certain. But the guy he brought in, he was all excited about it because I saw this toilet as a horrible thing sitting in front of the fireplace with all the copper wire ripped out of the drywall. I was ready to run. It was like 80% vacant. It was a nightmare. But to Kenny on the finance side, it was an opportunity because he knew his business plan was to take it from 25 to about 45 million.
And going back to where we first started talking about when we met and Kenny said, I can't manage your 60 units, 70 units because it's too small, is because he had this whole team that he has on his side that would be too small for his team to manage, and it wouldn't bring him any financial benefit as well.
Yeah, so
that's the importance of a team.
It doesn't mean don't start small.
No, start small.
Start small.
Yeah.
But the benefit is you always have dreams of going to big on this side here. Right, Kenny? Because you started as a property manager in college.
Absolutely. I started, well, actually, my first investment was a 2-bedroom, 2-bath. I used my own money. And now, the deals that we're doing obviously require like $20 million down. And, I use other people's money. So you go from, using your own to learning how to use other people's. And that's actually the way the system is set up. And
That's capitalism.
Yeah, it's literally set up that even people put their money in insurance policies and pension plans and 401ks and all that kind of stuff. There are people managing that money, and when you get your statement, somebody is putting it somewhere to make it, make that money. So, and so you just want to be on that side of it. We borrowed from insurance companies, we borrowed from pension groups, we borrowed from banks, we borrowed from life companies. People, when all this stockpile of money people are investing or saving, it needs to go to use. So there's a velocity of money that has to happen somehow, and so they look for people like our company. And
my final comment is, if you're starting small and you're just starting, don't use other people's money until you know what the hell you're doing.
Yes.
Because that's a big responsibility. That's a big responsibility. Learn on your own money for a little bit. That's what Kenny did. That's what we did. And then once you've got the experience, you got the knowledge, then you can take it to the next level.
Yeah. And please get, if you want to go to the next level, start small, get Tom's book and get Kenny's 3 books, because it's a very sophisticated game. It's what capitalists do. It's what Donald Trump does and Hillary doesn't.
taxes this is a complex game. So don't think it's that simple. I would echo your point, Kim. Start with your own money, start with your small deals. But remember that as you get more experience and more education, you're going to need up your team as well. I mean, you guys, let's face it, you haven't always had me and Kenny on your team. So you had to up your game too. And as you upped your game, you had to increase the level of your team members. And that's critical because not everybody, you can pay a lot of tax and still own real estate if you don't have the right team members.